Okay, so it is official that the US are in a recession. The BEA released the GDP stats earlier today showing a minus 0.9% figure. This made the necessary confirmation of the back-to-back negative quarters that are required to announce a recession following the negative 1.6 Q1. So what does that mean? How do we get here and what should we do next? In this video, I'm going to be explaining through my thoughts, some super interesting points, and what I'm going to be doing and why. So, number one, let's play a bit of catch up and understand how we got here in the first place. So as we mentioned earlier, to technically define a recession, there needs to be two back-to-back negative quarters reporting negative GDP growth. Now, that GDP measure is gross domestic product, and that essentially means, in short form, all of the value or the market value of the goods and services that a country provides. And this is looked at a quarterly basis, so essentially 4 bouts of 3 months where we can keep real tabs on the global economy. Now, the BEA, or the Bureau of Economic Analysis, are the people that produce these GDP stats. They go trolling through all of the data of the previous quarter and provide us with a 3-tier estimate. Now, the first estimate is called the advanced estimate, and this is the one that most people pay attention to. And the reason for this is because this is where most of the effort goes in, and they've got a good bulk of the data within this. The reason why there are those following 2 occurrences where they refine that figure is just due to not being able to collate all of the data all at the same time in order for that advanced estimate. So even whilst there are small deviations in those second and third estimates at times, it doesn't usually impact whether it's negative or positive. Now, of course, the reason why that we know that recession is here is because the advanced estimate for Q2 has just been provided today. So yes, whilst there are still 2 further revisions to go for the Q2, the reality is that there's not going to be that much change in this figure, and this was the one that everybody was waiting for. Typically, this advanced estimate is given 4 weeks after the final date of the quarter. So for Q1, this was April 29th, and then for Q2, this quarter is July 28th. Now, this Q1 reading was significant for 2 main reasons. Number one, it marked the first shrinking quarter of the required 2 to mark a recession, and this started sparking more fear in the markets and triggered much more of a bear trend to take place. The other fact is this was coming off of Q4, which had actually posted positive results of plus 6.9%. Not only was this the highest increase in 18 months, but it was also quite a jump from going from plus 6.9% to negative 1.6%. But of course, just getting that negative result in Q1 didn't mean we were in a recession, at least not at that point anyway. And so this is where today's big announcement came for the advanced estimate for Q2. Anything below 0 would give that negative growth in Q2, which would signify the start of a recession. So one of the most accurate tools and the predictors that I use to try and understand what to expect is the Atlanta Fed's GDP Now tool. Now, this historically has been incredibly accurate when it comes to the BEA release. Now, they started projecting negative figures pretty early into Q2, which you can see in this chart here. And you can see how their predictions for the best part over the course of the quarter have just declined and declined. All the while, the blue chips consensus never even dipped into negative territory. Take that as you will. But the final prediction from Atlanta Fed's GDP Now tool came in the day before at negative 1.2%. Now, the accuracy of the Atlanta Fed tool is also backed up by them. You know, they give the fact that they do have a margin for error on any of the stuff that they're producing, which generally tends to be within 0.84% of the quoted figure. But as it happened, the BEA released a true figure of negative 0.9%, which actually means the Atlanta Fed prediction was only 0.3 out. Now, of course, this does beg the question in terms of how on earth could the blue chip consensus be so far out and be so confident that we weren't going to get that negative figure, but maybe that's a conspiracy theory for another video. Now, of course, there were 2 other factors that needed to be considered in terms of how we were getting here now, and that was that King Powell had hiked up those interest rates to try and combat against the crazy inflation that's being experienced in the US in an attempt to deter borrowing by increasing costs, lowering eligibility, and therefore restricting the amount of available disposable cash for the average Joe. Now, whilst inflation and recession aren't the same thing, despite what many may think, they are very closely related when it comes to the GDP release figures. And this is mainly due to the fact that consumer spending accounts for around 70% of that GDP calculation. So if consumer spending is going down due to the fact that interest rates are going up and allowing less disposable income, then of course this will have a sway on that GDP figure, which in turn has a sway on a recession. And due to this is why the consumer spending and also the inflationary measures could stem far beyond just this quarter. Already we know that there is likely to be another interest rate hike, and eventually it will just be going up incrementally, probably for the next 12 months at least. We've also seen the big boys in the name of Tesla and Netflix laying off a bunch of staff, but this was actually in preparation when there could be a recession, but we weren't actually totally sure. Whereas now, this is an abundant reality. So a lot of those North American companies, scale-ups, startups, digital businesses may have to start making cuts to keep up with all of the economic activity that will be going on here. So this is my favorite favourite part of the video, what can we expect next? Now this is where I get to spitball a few ideas. I've done a ton of research into this to try and run through this with you on YouTube. Now I've made some assumptions that some people either agree with or disagree with, but I think it's quite interesting, and this is also dictating how I'm going to be acting with my money moving forward. Now, the US has had 34 recessions dating back to the 1850s, and the recessions themselves have varied from 2 months all the way to over 5 years. The average recession has lasted 17 months, whilst the 6 recessions post-1980s have actually averaged around 10 months. Now, the one thing to point out and get straight here is that you can have a bear market without a recession. So when we're taking a look at this table, we can see all of the bear markets, but not all of them have been accompanied with a recession. And within this, we can see specific stats relating to both eventualities. Of all of the historic data, a bear market without a recession averages around 12 months with an average loss of around 29% on the S&P. However, a bear market with a recession averages around 17 months with an average loss of 42% on the S&P. So where are we now in regards to the S&P? Well, if we take a look at the stats, from year to date, we are actually down 16.58%. And conveniently, you can actually pin the start of the declining market from the start of this year too. So here's what I'm going to do to sort of forge some predictions and run some stats for your own interest. Now, immediately I'm going to say that I'm ignoring the COVID recession, as it were, because that was over in 2 months. It was very reactive, and actually I think we're going to be paying the piper for that now. But aside from COVID, I'm going to be focusing on the last 45 years of market activity and trying to understand what our averages are with those recessions that have happened through that period. So with that in mind, we can see within that period we had 9 bear markets, of which 4 of those included a recession. And as you can see here, 2 of the recessions were some of the largest in history, with the dot-com bubble in 2000 and then the Great Recession repeated in 2007/2008. So of those recessions in the last 45 years, the average length of them was around 12.5 months. Now, there's a few schools of thought on this, but whilst today's recession, and depending on how this goes, it's likely that it won't be as bad as a 2007/2008 crash, but obviously there's different viewpoints on this and different people presenting different data. But if we look at the average drop of the S&P through those 4 recessions, we look at an average downside of 39.25%. Now, of course, things don't just work out magically with all the averages in the real world in comparison to our prediction world, but let's move on to what could we see next if we were to make a prediction. So let's say I look at those averages that I've just presented there, and we say that this recession could last around 12.5 months, in keeping with the average of the last 45 years of the last 4 recessions. This means that we could be in this recession probably until the mid to end of January 2023. I know some experts have said by the end of Q1 in 2023, but I'm just going on the averages that I've presented in this video. The other average, of course, to consider is the one that we just mentioned, which is the average drop on the S&P from the peak, which is 39.5%. So with us currently today sat at negative 16.5% on the S&P year to date, we are roughly about 7 completed months into the recession so far. So on that basis, we could be looking at a potential further downside of 23% from this point over the next 5.5 months. And if we were to take a look at this feasibly on an actual chart, there is a high chance that we could get down to that 2,900 marker, which is midway down the COVID drop territory and those kind of prices back in 2020. So that's what we could expect on the downside, but of course completely hypothetical at this point. But what could we expect on the upside? So if we look at the last 4 recessions over those last 45 years, the ones that we've been referencing to this point, we actually find some quite alarming stats if you look at how much it recovered. So from the bottom price of the recession to the top price before the next recession kicked in. Having a look at this over the previous 4 recessions gives us an average growth of around 377%. So to reiterate, that is from the bottom price, so where the recession bottomed out, to then the top price of when the next recession kicked in. And if you average out the gaps between them, and that's including from the 2008 crisis to today's recession, the average is around 9.5 years between them. Now, of course, to reiterate, I have excluded COVID from this conversation, which I'll probably get a ton of heat for, but at the end of the day, it's my video and I'm talking through what I'm thinking. I mean, the only reason I am doing it is because it was more of an anomaly in the great scheme of things, and it wasn't necessarily a financial crash that caused that drop. It was the global pandemic and then the massive tail wagging the dog, as opposed to if you were to compare that to the housing crash, which was essentially created from the corporations, and the dot-com bubble, which of course was again technology related, and the fact where greed had taken over. If anything, the recession now is probably more representative of what we should have had in COVID, because we got that greed drive and artificial inflated prices over that period because we had so many people investing and making a ton of money. But look, that aside, the long and short of these stats is basically saying to me, if we get to the bottom of this recession, or when we get to the bottom of this recession, the averages may point that we could be looking at a 377% gain, over around 9.5 years until we get to the next proper recession. Now, if we're doing it based on those averages, of course, if we're looking at where we thought the low could get to, which we showed on the chart, which was around the 2,900 mark, with this increase, this could mean we go up to and around sort of 13,500, 13,600. But of course, undoubtedly, we're going to be running through some bear markets on that way. It just may mean that we're not in a recession when those bear markets hit. So what am I doing from here, and what is my stance on it all? Well, of course, I've decided to make the stats fit my video in terms of what I wanted to show in terms of how my head was computing. Of course, a lot of people would decide to look at much larger sample sizes. I chose to focus on the last 45 years and decide to take my averages from that. Of course, these big figures and big recovery figures, whilst they may be accurate in theory, that isn't how the market moves on an annual basis. So often we can get big profits, we can get mediocre profits, we can even get losses. So what I'm not saying is that we're just going to have the bottom of the recession and then a nice path all the way up like a rocket. The other thing to bear in mind as well, since the last great recession, so not COVID, but the 2007 and 2008 one, we actually had two bear markets that sat between then COVID, and then of course now. It just so happens that those bear markets weren't accompanied with the recession status. However, maximum growth for your capital and being able to get a real generational jump on what you're trying to do with your financial goals is made in recessions. Whilst it's scary to start investing in recessions, it's actually the best time to do it, because this is where the fear takes over within the economic cycle. We head down into a recession, potentially even a depression, and then we start pushing out of the other end. The question you really have to ask yourself is, in 10, 15 years time, do you believe that the US economy is going to be in a better position than it is now? If the answer is yes, then it's a no-brainer to sort of invest long term. If the answer is no, then by all means, go and invest in something else, maybe look for emerging markets. That is one area, just on a slight tangent where this is focused on the US and the S&P 500, I do feel that people are underutilizing emerging market, whether that be index funds or whether it be individual indices, companies within those fields. But emerging markets will of course take much more of a precedence over the next 10 or 15 years too. But as for what I'm doing, for me, it's business as usual. I've been hoarding a lot of cash over the last 6 to 12 months, preempting this recession, and especially after that Q1 negative and looking at the state of the economy with the Atlanta Fed predictions, I was holding on to a lot more and not dollar cost averaging as much as I would or as frequently as I would normally. So now that this has been announced, I will be dollar cost averaging fairly aggressively on a weekly basis now, probably until the end of Q1 next year. As always, this video is just me spewing my own thoughts, demonstrating some data that I found moderately interesting, but I'm keen to hear your thoughts. What do you think of the whole thing? What are you expecting and what are you doing in these conditions? Let me know in the comment section below. If you have enjoyed this video, but especially if you haven't, please hit that like up button. It goes a huge way to supporting me as a creator. Smack subscribe if you haven't already, and make sure you've got the alerts turned on so you don't miss when I post another interesting video. Anyway, if I don't speak to you before, have a cracking rest of your week, and I'll catch you on the next one. Take it easy.